Hello, and welcome to a special edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer of Morgan Stanley Wealth Management, and today is Monday, November 17th, and I'm recording this from New York City. After COVID-era inflation peaked at 9%, many investors assumed that price pressures in the U.S. would fade as quickly as they had arrived. Yet here we are 3 years later, with inflation still running around 3%. Well above the Federal Reserve's 2% target. Many policymakers and investors have continued to characterize this as transitory, but our Global Investment Committee is asking a bigger question. Could this be the start of a new inflationary regime, one where price pressures remain higher for longer? This possibility deserves serious consideration in our view. While cyclical factors like tariffs and fiscal stimulus may be playing a role in driving prices higher over the near term, we see deeper structural forces emerging, including bottlenecks in labor, housing, and energy markets, and these forces are ones that could persist for years. Let's unpack each in turn. First, labor. For decades, immigration helped offset demographic headwinds. But this year's dramatic shift in immigration policy is beginning to be felt, and projections for 2025 suggest that the U.S. could even see its first year of negative net migration in more than 60 years. This is a major constraint for industries like construction, manufacturing, and healthcare, where immigrants make up as much as 30% of the workforce. The U.S. population itself is aging rapidly. And if we exclude the period defined by the COVID lockdowns, labor force participation is drifting to its lowest levels since the 1970s. These trends suggest that labor shortages and the wage pressures that they create are not necessarily going away anytime soon. Second, we would talk about housing. America's housing market is chronically undersupplied with a shortage of nearly 5 million units. Restrictive zoning, a lack of skilled labor, and higher construction costs have all contributed. But perhaps the most powerful dynamic is what we call the mortgage lock-in effect. Millions of homeowners took out mortgages at historically low interest rates several years ago, and many even refinanced into mortgages with rates under 3% during the pandemic. Now, with the 30-year average mortgage above 6%, these homeowners are understandably reluctant to sell. The result, far fewer homes are on the market, higher prices, and sticky shelter inflation, even as broader price increases may cool elsewhere. Third is energy. The nation's electricity grid was built for a different era, yet demand is currently soaring, driven by AI, cryptocurrency, electric vehicles, data centers, and the reshoring of manufacturing. Data centers alone now consume nearly 5% of U.S. electricity, and the International Energy Agency projects that the energy they need could more than double by 2030. Meanwhile, the grid's aging infrastructure and the long timelines required for new power plants to secure that transmission capacity have created bottlenecks that will take years to resolve. Together, these constraints point to sustained upward pressure on electricity prices, a dynamic that feeds directly into inflation across the economy. On top of these structural bottlenecks, we have a policy environment that's becoming more constrained, most specifically with federal debt near 120% of GDP and deficits running close to 7% per year. The U.S. is spending roughly 1 out of every 5 tax dollars just to service debt. This raises the risk of what we call fiscal dominance, a situation where the Fed's flexibility to fight inflation is limited by the government's borrowing needs. Markets are already sensing this tension, and term premiums on long-term treasuries have risen and the dollar has weakened, 2 factors that contribute to inflation. What does all this mean for investors? A higher for longer inflation regime could mark a turning point. The playbook that defined much of the past 15 years after the great financial crisis, one of low inflation, low rates, the dominance of passive investing in equities, may give way to something very different. As a result, we believe investors need to adapt their portfolio strategy on a longer-term basis in several ways. First, emphasize pricing power within equities and favor some active management. Second, let's diversify globally and beyond dependence on the U.S. dollar as relative value opportunities emerge in select international markets. Third, we need to own real assets like infrastructure, commodities, and precious metals, which can help hedge inflation and policy risk. Finally, we need to be proactive in managing duration risk in fixed income and focus on the highest quality credits and prepare for higher volatility and changing cross-portfolio correlations. As always, thank you for listening, and for more information about all of this, see our full special report. If you'd like a copy or have any additional questions, please reach out to your Morgan Stanley financial advisor.